Have you ever wondered why some traders consistently make fortunes in the market, while others, perhaps even yourself, struggle to maintain their accounts despite having similar knowledge? What if I told you that the secret to trading success has nothing to do with complex strategies, advanced algorithms, or having insider information? The markets are brutal battlefields where most participants leave wounded or defeated. Yet through centuries of trading, from the bucket shops of the early 1900s to today's high-frequency digital exchanges, one profound truth remains unchanged. The psychology of markets never changes. Only the faces and technology do. But before we begin exploring exactly how to develop this rare skill that could potentially transform your trading results forever, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Has this ever happened to you? You spot a promising setup, enter a trade, watch it move in your favor, and then you sell. You take your small profit, congratulating yourself on a win, only to watch in agony as that same position continues climbing day after day, week after week, without you on board. What could have been a life-changing gain becomes just another forgettable transaction in your trading journal. Stay with me until the end, because what you're about to discover might completely transform how you approach the markets. Jesse Livermore, perhaps the greatest trader who ever lived, identified a single rule that separates the 1% of successful traders from everyone else. It's deceptively simple. Sit tight. There is one rule, just one, that 99 out of 100 men can't keep to, Livermore observed. Sit tight. Not buy, not sell, not rush in with the crowd, but sit to wait when the waiting is hardest. This principle sounds elementary, almost insultingly basic, yet its simplicity masks an extraordinary difficulty in execution. The market's genius lies in its ability to prey upon human nature itself. While our minds intellectually understand the concept of patience, our emotions scream for action, validation, and the dopamine hit of closing a profitable trade. Think about it. How many times have you exited a position too early, only to watch it soar afterward? The haunting what-ifs that follow aren't coincidental. They're the market's way of teaching you its most valuable lesson, if only you'd listen. What makes sitting tight so difficult isn't a lack of knowledge. It's fighting against the very wiring of our brains. The markets have remained unchanged in this psychological warfare for centuries. From the panic of 1907 to the crash of 1929, from the dot-com bubble to the 2008 financial crisis, the fundamental patterns of human behavior persist like clockwork. Now, imagine if you could master this one principle that has made fortunes for the select few throughout market history. The ability to stay seated when every instinct in your body is screaming to take action. If you want to master the psychological edge that separates the 1% from everyone else in the markets, hit that subscribe button. I'm committed to sharing these timeless trading truths that most gurus never discuss. The transformation begins when you recognize this fundamental truth. The Pisces moment you feel that warm, intoxicating glow of certainty as your position moves in your favor is precisely when you're most vulnerable. It's a paradox of trading psychology that success often plants the seeds of failure. That rush of dopamine, that validation of your analysis, it creates an almost irresistible urge to lock in your gains. Livermore called this nibbling, taking a small bite when a feast awaits. When a position begins moving favorably, most traders experience a mindset shift from hope to fear. What if it reverses? What if I lose these profits? This hidden anxiety triggers premature selling, cutting the wings of positions just as they're preparing for takeoff. I remember watching a stock climb steadily for weeks. A friend of mine, an active trader, kept buying and selling the same security, proudly showing me his collection of small wins. "I've made 10 points total," he boasted. Meanwhile, my single position, held through the inevitable fluctuations, gained 50 points. The revelation was stark. He had worked harder, stressed more, paid higher commissions, and earned significantly less. This pattern reveals a profound truth about wealth creation in markets. The big money isn't made in the frantic day-to-day scalping that most traders mistake for skill. It's made in the major swings, the extended campaigns where prices don't just move, they migrate to entirely new territories. When I first started trading, like most beginners, I rushed to the cashier with every small gain. My heart would pound with excitement, fearful the money might vanish if I waited another minute. The journey from this anxious approach to genuine confidence requires understanding that these small victories are merely crumbs swept from a banquet table where others are feasting. The decision to embrace patience doesn't come easily. Our culture celebrates quick results, instant gratification, and constant activity. We've been conditioned to equate busyness with productivity, action with progress, yet the market operates by different rules. It rewards those who can resist this cultural programming and align themselves with larger movements. Consider the impact of this principle applied consistently. One well-chosen position, held through inevitable fluctuations, can outperform hundreds of smaller trades. Not just in returns, but in reduced stress, lower transaction costs, and vastly improved tax efficiency. The market's biggest moves develop slowly, often beginning with unimpressive sideways action that frustrates the impatient. While most traders are jumping from one quick trade to another, the disciplined few are positioning themselves for the significant price migrations that create real wealth. Now, I want to go even deeper into what separates gamblers from true market operators, because understanding this distinction will illuminate why most traders, despite knowing better, continue to sabotage themselves by exiting winning positions prematurely. If anything I've said so far resonates with your own trading experience, type "guilty as charged" in the comments below. It's a confession I've had to make myself more times than I care to admit. The journey to trading mastery reveals a profound insight. What truly distinguishes successful market operators from mere gamblers isn't superior intelligence or privileged information. It's something far more elusive: patience coupled with judgment. This revelation often contradicts our expectations, as we naturally assume the most successful traders possess some secret knowledge or analytical edge unavailable to the rest of us. "Do you know what separates the gambler from the operator?" Livermore asked. "It isn't brains. Plenty of clever men go broke in Wall Street. It isn't information. It's patience. The gambler exhibits a characteristic pattern, constantly dipping in and out of positions, forever chasing the next quick hit. Their decision-making happens in reaction to market noise rather than market truth. The operator, by contrast, exercises a different mindset entirely. They identify the prevailing trend through careful observation, establish their position accordingly, and then perform the most difficult task of all: they wait. This waiting isn't passive. It's an active discipline requiring tremendous self-mastery. It demands the courage to stand apart from the crowd and the conviction to trust your analysis even when the market temporarily moves against you. Behind the scenes of every great trading fortune lies this untold story of patience. Consider this paradox: the moments that test traders most severely aren't the dramatic crashes or explosive rallies that dominate financial headlines. Rather, it's those tedious sessions where prices inch sideways, seemingly going nowhere, the market equivalent of watching paint dry. These dull days create a unique psychological pressure. They trigger what psychologists call action bias, our innate tendency to believe doing something is better than doing nothing, even when inaction is the optimal choice. During these periods of low volatility and directionless markets, a subtle inner voice begins whispering, "Your capital is sitting idle, you're wasting time, others are making money elsewhere." I remember watching Union Pacific during one campaign. The tape showed strength, buying was real, and everything pointed higher. I established my position, and then came what Livermore called the idle days. Every instinct screamed to take my profits and move on. Those tedious sessions where price inches sideways break traders faster than any crash because they create the illusion that opportunity is slipping away. The journey to trading mastery is better traveled together. Subscribe now to join our community of patient operators who understand that sitting tight is the hardest and most profitable skill in the market. The transformation happens when you recognize that these periods of apparent inactivity are actually crucial incubation phases for major moves. The market is quietly redistributing shares from impatient hands to patient ones. It's testing who deserves the coming rewards by seeing who can endure the boredom of waiting. This perspective shift represents a profound evolution in a trader's journey. Most never make this transition. They remain trapped in the gambler's mindset, believing more activity equals more profit. They keep themselves busy with constant transactions that create an illusion of progress, while actually eroding their capital through commissions, slippage, and poor decision-making. Now, I want to explore the true enemy that prevents most traders from developing this patience, the role of fear in our decision-making process, and how it systematically undermines our best intentions in the market. If you've ever found yourself unable to sit through these boring market periods, type "patience in progress" in the comments. Acknowledging this challenge is the first step toward conquering it. Fear stands as the true adversary in a trader's journey to mastery, not market volatility, not competition, not even lack of knowledge. When you have aligned yourself with the truth, when your position is right and the trend is with you, why rush to close it? Livermore asked. Because you fear loss. That is the true enemy, fear. This revelation cuts to the core of trading psychology. The specific fear that undermines most traders isn't fear of losing their initial capital. It's the deeper, more insidious fear of giving back profits already gained. This distinction marks a crucial mindset shift. Once you've seen a position move in your favor, those unrealized gains create a psychological ownership effect. You begin to count that money as yours, even though it exists only on a screen. Behind the scenes of nearly every prematurely closed winning trade lies this same narrative. I can't bear to see these profits diminish. This emotional attachment to paper gains becomes a decision trap that systematically cuts short your winners precisely when they have the potential to become transformative positions. Consider the impact of this fear on your trading results. When you sell a winning position too early, you're not just missing additional profits, you're fundamentally altering your risk-reward equation. By systematically cutting winners short, while inevitably encountering full-sized losses, the mathematics of success become increasingly challenging. The hidden truth about market success is that it often requires a complete inversion of conventional thinking. While the crowd perceives trading as constant excitement, a rapid-fire sequence of buy and sell decisions punctuated by adrenaline and dopamine, successful operators experience it very differently. For them, trading consists of long hours of patient waiting, interrupted by brief moments of decisive action. The operator thinks of trading as hours of waiting, punctuated by moments of action, Livermore observed. The money is made in the waiting. This perspective represents a profound paradigm shift. The work of trading isn't found in frequent transactions, but in the disciplined restraint between them. I've witnessed traders who make dozens of transactions daily, creating an illusion of productivity while their accounts slowly erode. Meanwhile, the disciplined few who understand this principle might make only a handful of trades per year, yet each one represents a carefully selected campaign with potential for substantial returns. The ultimate irony is that the path of patience actually requires greater courage than constant activity. There's a certain comfort in action, the illusion of control, the momentary relief from uncertainty. Sitting still through market fluctuations demands emotional resilience that few develop. It requires trusting your analysis even as the market temporarily moves against you, and resisting the cultural programming that equates busyness with productivity. Let me share something I've observed across years of market participation. The transformation from amateur to professional trader often occurs precisely when one embraces this counterintuitive truth, that inaction, properly applied, is the highest form of trading skill. Now, I want to explore how this principle operates across different market conditions, because one of the most common misconceptions is that patient positioning only applies during bull markets. If you've ever closed a winning position too early due to fear and later regretted it, type "fear conquered" in the comments. Naming our obstacles is the first step toward overcoming them. A profound insight that few traders fully grasp is that the principle of sitting tight applies with equal power across all market conditions. The misconception that this wisdom only works during uptrends has cost countless fortunes. In bear markets, Livermore observed, the same law applies. I have seen men sell short correctly, seen them catch the turn only to buy in with the first rally. This pattern reveals a fascinating symmetry in market psychology. Whether positioned long in a bull market or short in a bear market, the same emotional triggers disrupt disciplined execution. During downtrends, traders who correctly identify the turning point and establish short positions often cover at the first minor bounce. They take their quick profit and congratulate themselves while the real opportunity unfolds. Without them, as prices continue their significant descent. The revelation here is that human psychology operates identically regardless of market direction. The same fear that causes premature selling in bull markets triggers premature covering in bear markets. In both scenarios, the trader surrenders the substantial move for a fraction of its potential. Behind this behavior lies a curious paradox about human nature. Many traders find it easier to accept ruin than riches. They'll hold losing positions indefinitely, clinging to hope despite mounting evidence, yet they'll eagerly terminate winning positions at the first hint of resistance. This asymmetry in decision-making creates a systematic disadvantage that few overcome. The transformative truth that shaped Livermore's extraordinary career was disarmingly simple. The big money is not in the buying and selling, it is in the waiting. His greatest fortunes came not from clever entry and exit timing, but from the disciplined patience to remain positioned during extended market movements. This journey from active trader to disciplined operator represents the true evolution in market mastery. What makes this principle so challenging isn't its complexity, but its simplicity. Cut your losses, let your profits run. Every child of Wall Street mouths it as though it were a nursery rhyme, Livermore noted. But to obey it, truly to obey it, that is another matter. Most traders intellectually acknowledge this wisdom while emotionally unable to implement it. I've witnessed countless traders meticulously study market patterns, develop sophisticated strategies, and build robust analytical frameworks, only to sabotage their results through premature profit-taking. The mindset breakthrough occurs when you realize that trading mastery isn't found in more advanced techniques, but in the disciplined execution of fundamental principles. Consider the impact on your trading results if you could simply extend the duration of You're winning positions while promptly exiting losers. This single adjustment, holding winners longer, often makes the difference between mediocre and exceptional returns. Yet it remains the one discipline most traders cannot maintain. The market reveals this truth repeatedly, but most participants refuse to accept it. They believe their success will come through more sophisticated analysis, faster execution, or privileged information, when in reality, the decisive factor is the emotional discipline to allow profitable positions to develop fully. Now I want to explore why waiting is actually harder than taking action in the markets, and how this counterintuitive reality shapes the psychology of successful traders versus the merely active ones. If you've noticed this pattern in your own trading, intellectually knowing you should let winners run, but emotionally struggling to do so, type "patience is power" in the comments. Recognizing this gap between knowledge and action is the critical first step toward transformation. One of the most profound revelations in market psychology is understanding that markets are designed to prey upon fundamental weaknesses in human nature. The market pays those who can sit because the big movements, the real campaigns, take time to develop, Livermore observed. Yet sitting still, doing nothing, represents the most unnatural act for most traders. The market systematically exploits this impatience, creating an environment where the majority, inevitably, surrender their capital to the disciplined few. This dynamic creates a natural wealth transfer mechanism. Markets don't distribute returns randomly. They systematically flow from the impatient to the patient, from the restless to the disciplined. The journey from average trader to exceptional operator often involves recognizing this uncomfortable truth. The market is structured to take advantage of your natural tendencies toward action. Think about your own decision patterns. Have you noticed how the market seems to reverse shortly after you exit a position? This isn't coincidence, but design. The market's fluctuations are calibrated to shake out the majority before the genuine move occurs. Those brief, seemingly random reversals that triggered your exit weren't random at all. They were the market's way of collecting positions from weak hands before continuing its primary trend. What makes this reality particularly challenging is that our entire culture celebrates action over patience. From early childhood, we're conditioned to equate busyness with productivity, movement with progress. The revelation that inactive patience could be more profitable than active trading contradicts everything we've been taught about success. This cultural programming creates a powerful headwind against adopting the very mindset needed for market success. The second crucial insight builds upon this foundation. Truly significant market campaigns, the kind that generate life-changing returns, are remarkably rare. They don't appear daily or weekly, as the financial media might suggest. They emerge perhaps a few times annually, sometimes even less frequently. This scarcity creates a fundamental decision point for every trader. The crowd, unable to tolerate inactivity, scatters their capital across dozens or hundreds of minor opportunities. They chase every flutter, react to every headline, jump from stock to stock seeking constant stimulation. Their journey becomes a frenetic pursuit of activity rather than results. Meanwhile, the disciplined operator preserves their capital and attention for those rare but powerful opportunities. The great campaigns that make a fortune do not come every day nor every week, Livermore noted. They are rare, like comets streaking through the night sky. This perspective shift transforms how you approach markets. Instead of asking, "What should I trade today?" the question becomes, "Is today one of those rare opportunities worth deploying capital, or should I continue waiting?" I've watched traders exhaust themselves chasing minor movements, their attention fragmented across too many positions, their capital depleted through excessive trading costs. When the genuine opportunity finally arrives, the comet streaking across the market sky, they're too depleted to capitalize on it. Their resources have been scattered like seeds on infertile ground. The transformative moment in a trader's development comes when they recognize that most days demand inaction rather than action. The discipline to preserve capital, maintain focus, and resist the siren call of activity until the genuine opportunity presents itself, this represents the hidden edge that separates the consistently profitable from the perpetually frustrated. Let me take you deeper into what many consider the hardest aspect of implementing this philosophy, the psychological challenge of sitting still while others around you appear busy and productive in the markets. If you've ever found yourself chasing multiple small opportunities instead of waiting for the rare big one, type quality over quantity in the comments. This mindset shift might be the missing piece in your trading journey. Perhaps the most counterintuitive revelation in trading psychology is that waiting, doing absolutely nothing, requires more courage than taking bold action. Waiting is harder than acting, Livermore observed. The man who can stand idle while others are in motion needs more nerve than the boldest plunger. This insight contradicts our natural assumptions about courage in the markets. Consider the emotional landscapes of two different traders. The active plunger, constantly buying and selling positions, feels the temporary comfort of control. Each transaction provides a momentary relief from uncertainty, the illusion of progress, even when losing. Meanwhile, the patient trader sitting with a position experiences something far more challenging, the silence of their own thoughts, the weight of uncertainty, and the constant temptation to do something. The journey toward market mastery often begins with a fundamental misconception that trading skill is measured by activity. In reality, the discipline to remain inactive during inappropriate times represents a higher evolution of trading consciousness. It's the difference between a novice musician who plays constantly without rhythm and a master who understands the crucial importance of rests and silence in creating harmony. Behind the scenes of every great trading fortune lies this untold story, not of brilliant timing or sophisticated strategies, but of psychological fortitude. The ability to endure market noise without reacting, to withstand the social pressure of appearing inactive while others bustle about, to master the hardest work in speculation, no work at all. This discipline becomes particularly valuable when we understand the second crucial truth. Significant market movements develop with remarkable slowness. The breakthrough doesn't arrive in a single dramatic session, but unfolds gradually over extended periods. A stock may spend days fooling around in a narrow range before it begins its climb, Livermore noted. Then once it starts, it will run for weeks or months. The market's genius lies in its tempo, moving just slowly enough to bore the impatient into abandoning ship before the real journey begins. This developmental pattern creates a natural selection mechanism where only those with the patience to endure the initial doldrums remain positioned for the eventual acceleration. I've watched countless traders jump in and out of positions during these early consolidation phases. They buy, become frustrated with the lack of immediate movement, sell, and then watch in dismay as the stock finally breaks out and runs without them. The revelation is that fortunes aren't made by catching every tick of a move, but by simply remaining aboard for the entire journey. The transformation in your trading results comes not from more sophisticated entry timing, but from the simple discipline of extending your holding period on winning positions. This single adjustment, allowing winners to develop fully rather than cutting them short, often produces more significant improvements than any technical refinement. Consider the mindset shift required. Instead of asking, "When should I sell?" the question becomes, "Is there any valid reason to sell?" This inversion places the burden of proof on the exit decision rather than the continuation decision, fundamentally altering your relationship with market positions. Let me take you deeper into a fascinating psychological pattern that sabotages most traders. How the desire for constant activity creates an addiction to meaningless movement at the expense of meaningful results. If watching a stock drift sideways makes you anxious and triggers an urge to take action, type "stillness is strength" in the comments. This internal struggle between patience and activity defines the trader's journey toward mastery. The most liberating revelation in a trader's journey comes when they truly grasp that one campaign well held vastly outperforms 100 small trades. Livermore experienced this transformation firsthand. I remember a time when I watched a stock climb point by point for weeks. A friend of mine, an eager trader, kept scalping it. By the end of the campaign, he had made 10 points. My position had made 50. This stark contrast highlights a fundamental truth about wealth creation in markets. The scalper, darting in and out for quick gains, experiences an illusion of productivity. They can point to numerous winning trades, count their small victories, and feel accomplished. Yet behind this facade of success lies a harsh reality. Their account grows slowly, if at all, while their nerves fray and their energy depletes. Meanwhile, the campaign trader, who places one well-chosen position and holds through inevitable fluctuations, often walks away with significantly more capital and less emotional exhaustion. The revelation isn't that small trades never work, but rather that the effort-to-reward ratio is dramatically skewed toward fewer, more significant positions held for longer durations. The psychological challenge lies in overcoming what psychologists call the illusion of control. Our tendency to believe more activity gives us greater influence over outcomes. In trading, this manifests as excessive position management, constant monitoring, and premature exits. Each action provides momentary comfort but undermines long-term results. Consider the hidden costs of the scalping mindset. Beyond the obvious commission drag and tax inefficiency lies a more subtle penalty: opportunity cost. Every moment spent chasing minor moves represents attention diverted from identifying and positioning for significant trends. The scalper's journey becomes a self-reinforcing cycle of busy mediocrity rather than patient excellence. The market rewards vision and patience, not hustle, Livermore observed. This insight contradicts much of our cultural programming about success. We're taught that more effort yields better results, that hard work inevitably leads to achievement. The market, however, operates by different rules. It systematically punishes the busy and rewards the steadfast. The scalper feeds on scraps because they cannot endure reactions, those temporary reversals that characterize every significant trend. They sell at the first sign of resistance, taking small profits while abandoning the position just before the genuine move develops. Their decision-making becomes reaction-based rather than vision-based. Meanwhile, the campaign trader sees beyond immediate fluctuations to recognize the greater tide. They understand that temporary setbacks aren't failures, but natural components of larger movements. This perspective shift creates extraordinary resilience, the ability to withstand short-term volatility while maintaining focus on the primary trend. I witnessed this contrast dramatically during the tech boom of the late 1990s. While most traders frantically jumped between positions, those who identified key companies and simply held through the inevitable fluctuations created generational wealth. Their edge wasn't better analysis or faster execution. It was simply the psychological fortitude to remain positioned. Let me take you deeper into exploring perhaps the most challenging aspect of implementing this philosophy: how to distinguish between normal market fluctuations that should be endured versus genuine reversals that demand action. If you've noticed yourself frequently taking small profits while missing the bigger moves, type "holding for wealth" in the comments. This simple acknowledgement might be the first step toward transforming your trading approach. As we've journeyed through Livermore's timeless wisdom, I hope you've recognized parts of your own trading psychology in these patterns. The market continues to operate by the same principles today as it did a century ago, testing our patience, exploiting our weaknesses, and rewarding those rare individuals who can master themselves before attempting to master the markets. The transformation from busy trader to disciplined operator doesn't happen overnight. It's a gradual evolution requiring honest self-reflection and the courage to act differently than the crowd. Remember, Livermore's profound insight: the difference was staggering. He may not have traded once in the same week I made a dozen turns, but his single position grew larger than all my busy winnings combined. This approach isn't just about making more money, it's about reclaiming your time, energy, and peace of mind. The freedom that comes from breaking the addiction to constant activity represents perhaps the greatest wealth of all. If these ideas have resonated with you today, I'd love for you to become part of our community of thoughtful traders. Hit that subscribe button so we can continue exploring these psychological edges together. These are the insights that create genuine market success, rather than the flashy but empty promises of get-rich-quick schemes. Take a moment to drop "patience pays" in the comments if you've made it to the end of this journey. Your comment helps others discover this content and reminds you of the commitment you're making to your own trading evolution. If you found value in today's exploration, that like button is a simple way to let me know. These deeper dives into trading psychology are worthwhile. Each like helps this message reach others walking the same path. I've created a video right here that explores the specific techniques for identifying those rare, significant market campaigns that Livermore spoke about, the kind worth holding for substantial returns. Click through and let's continue building your psychological edge together.